So you're here in this room because you own at least one multifamily property in a city that my team and I represent landlords in the purchase and sale of multifamily properties. And the premise of the event has never changed. Address the pressing issue at the time. Now, some of us wish we could go back 6 and 7 years where the most pressing issue was maybe, well, my tenant, they're putting a sweater on the dog. They're now trying to call the dog an emotional support animal. Well, I would like to make my building a non-smoking building. Some of the years when real estate was flying high at our events, that was about the most pressing issue. Today, as we sit here, there's not one, but 7 issues that are impacting multifamily ownership. And if landlords are not informed and are able to surround themselves with the right professionals that they can reach out to, they're likely to step on a landmine here. From 2020 to 2023, we had a historic gain in rental rates. Rents went up by about 20%. It was the highest gain in rental rates that we've ever seen historically since they've been tracking rental increases. Well, here, about the last 12 months, they've now began to pull back. Why? Because people are pinched. You and I, as the landlords in the room, are having a different experience of the economy than our tenants are experiencing the economy. People are doubling up, vacancies increasing, so rents have pulled back. If rents cannot keep pace with inflation cost, then profits will plummet. That's issue number 2. Back to interest rates. Now, some of you may be thinking, well, Kris, the Fed just lowered the rate 0.5%. They promised to lower them more. Isn't that going to be a saving grace? Well, we have Gil Figueroa in the room here who's going to explain to us why the exact opposite has happened and rates have actually gone up. But let's say, for argument's sake, that interest rates were to take a trajectory downward. Well, historically, it takes the market anywhere from 1.5 to 2 years to change direction and values to move in a positive direction. So even if we begin to see lower interest rates, we could be 18 months to 24 months away from a change in direction in values. And that's meaningful, obviously, to landlords. You and I, as housing providers, landlords, have a target on our back. And I don't say that lightly. But between the politicians, the tenant advocacy groups, and the culture at large that demonizes landlords, it's common thought that you and I should bear the brunt of the economic woes of the state, the shortage in housing, and that has led to more tenant protections. If you had an eviction, say about a decade ago, there was free representation for tenants, but BASTA was one of the main groups around. There wasn't that many. Today, they're everywhere. We'll have with us today Mr. Mike Brennan, eviction attorney extraordinaire, to explain something to us called right to counsel. And if you haven't heard what this means, that means that your tenants, on your dime, your taxes, are going to get free representation for every eviction that you have here in LA County to start with. And they're going to bluff you all the way to a jury trial. And your evictions are going to cost you 3 and 4 times what they used to, not to mention the loss of peace of mind and the loss of your time. Some cities now have their own version of rent control, an extra layer of protection for the tenants on top of statewide rent control. So under statewide rent control, the ceiling is 10%. But some cities have a ceiling of 5% or inflation, whichever is lower. Some have 4% or inflation, whichever is lower. Bell Gardens has half of inflation. So if you own a building at Bell Gardens, you can raise your rents this year a whopping 1.9%. And for those of you that are thinking, I'm glad I don't own in Bell Gardens. Well, where is it at currently? Santa Monica, Pasadena, Baldwin Park, Pomona, Cudahy. It soon will be at a city near you. And that's going to be very problematic, especially for folks who never attended our events and went on the chase to raise their rents above market, and we'll discuss that this afternoon. but that's going to be very problematic. In other words, I know what it is to be in the street as an investor yourself. And as I couple together my transactional experience and my experience as an investor, what I've come to understand is you and I are building a financial legacy by owning multifamily properties. And this financial legacy hinges on 3 pillars. The first pillar is maximization. Maximization focuses on a very specific set of capital improvements so that you can increase the value of your property or properties from within. That then increases the cash flow, with that the appreciation, the overall value, so that you have that much more equity and you have that much more money in your pocket.
I think it's been over 10 years that I've been at Kris's seminars, if not from almost the very beginning, and we've been analyzing rates and charts and doing technical analysis and letting his clients understand where the market's going. In October 21 seminar, which was, still deep in the COVID market, where everybody thought the rates would stay low forever, I jumped up and down and said, we're going up. And we're not just going up a little bit. We're going to go up quite a bit. So I said, this is I believe, a 24-year cycle channel. So you can see how the rates bumped up for 24 years in that cycle. The moment that it broke, you see our low at 3.98. That's actually 0.0398. That's how low rates got as far as the 10-year treasury. Once we broke, we doubled up. And my estimate was we're going to go to the top of that chart. My motto throughout my conversation is going to be, are you playing offense? Because obviously we have some issues. We have things that are happening around us that we can't control, okay? So what offense are you playing? Are you improving your property? Are you doing cash for keys? Are you trying to get the market rents now before any other proposition comes in and hurts us? We need to play offense. So that's what we're going to talk about today. I've been talking about inflation and stagflation before it started. And recently, the Fed is in a quandrum. And the quandrum is the fact that it's difficult to lower rates in an inflationary environment. So that's something that we've been looking at, and we're headed for stagflation. And the last time we were in stagflation was in the 70s. Who remembers those times? Okay, you do any gas car lines, odd and evens? I was in the car with my dad and back. I remember those days. So those are tough days and tough time. How did we get out of that time? We got out of that, what's called Keynesian economics, which is spending on infrastructure and spending. Can we spend our way out right now? I would say not. We're over leveraged. I'd say the world is over leveraged. So we expect some corrections coming very soon. So prepare, play offense, have a plan, please.
So we're gonna talk a little bit about 1031 exchange, but primarily we're going to focus on the Delaware statutory trusts, which are commonly called DSTs. There's another form of a DST called a deferred sales trust. We're not going to talk about that today, but I'm going to give you some examples of the Delaware statutory trusts. When you get involved in a program that's being brought as an investment program, you will typically have to be an accredited investor, which means you have a net worth of $1 million or more, without regard to your personal residence. So most of these programs that are in the market today, they are built for the accredited investors. And almost all of you in this room are easily accredited because of owning real estate in California. Now, what is a Delaware Statutory Trust and when was it first coming into the market? You can see this revenue ruling 2004-86. What that means is that Delaware Statutory Trusts really got their birth in 2004. They are a fractional ownership structure so that you can exchange out of your rental property, come into a DST, and you become one of a number of owners in the DST. And it's going to give you some certain advantages, which we'll go over in a minute. You can go into a DST that is diversified. It might have a lot of properties, almost like a little mutual fund of properties. or you can go into a DST that has one property in the DST. They are typically income tax and estate tax friendly. So people go into DSTs because they're doing 1031 exchanges of the real estate, and they're looking for a tax deferred way to get out of your current real estate and into an investment program that makes sense. So this is the investor profile. The investor that works with me, and I know there are a number of you that have worked with us in the past, and I appreciate working with you and having these number of years with you. But our investor profile, they're looking for tax deferral, number one. So they want that 1031 exchange because they don't want to have to pay that state and federal tax. Now in California, we have a 13.3% maximum tax. We don't have a capital gain rate in California. We just have a regular tax rate. It applies to all income. And then when you start to add the federal taxes, the Medicare surcharge taxes, you could easily be giving up maybe 40% of the total investment dollars. The second reason people are coming and doing 1031s is they're really looking for capital preservation. You've already heard from Kris where he mentioned that you're in different phases of your life, and this is typically for the retiree or the pre-retiree. Our average investor age, believe it or not, is 72.4 years old, okay? So those are folks that have made their money in real estate, and usually they have more real estate than any other type of asset, and that's probably common to this room. And so they're looking for preserving that capital. They don't want it to go away to the government. They want to preserve it. So safety is really important. Then they're looking for stable income. And a lot of times we can create a stable income inside the DST that might even be double or triple of what you're currently having. Our investor profile, they're looking for strategic exits, both from the property that they're engaged in today as a rental property, and then they want to know that they've got good exit possibilities from the DST that they're going into. But this example of 63, this is one of our programs that we did this year. And I want to just talk about this in particular, but it's going to illustrate what you can do with a DST. So in this program, you notice that the properties that are in it are typically names that you know: FedEx, Tops Market, Dollar General, Tractor Supply, BioLife. And this portfolio is made up not only of those tenants, but of additional tenants. And we're raising in this thing about $75 million. We go to the makeup of what could be in a DST, and this is just this one DST, okay? This one DST, we're raising $75 million, and we've already done this, by the way. This is not available for you. It's sold out, but $75 million. And we did this one for those investors that would need some debt. So we have a $50 million loan on it, and the investors don't have to qualify for the loan. I sign on the loan, what they call non-recourse guarantees, bad boy carve-outs are also called. I'm on the hook on those, but none of the investors are. So we've got $75 million plus $50 million debt. We've got $125 million in assets in this thing. And off of those assets, the tenant mix, as you can see in this pie chart, consists of FedEx, Tops Market, Schnucks Market, BioLife Plasma, Daybreak Market, Dollar General, Tractor Supply, Dollar Tree, Dollar General Plus. So you've got a mix, and what's it feel like? Feels like a mutual fund. Feels like a little mutual fund of property, and it's one that's going to generate income. Now, we have 1,283 properties now across the country that we've done this for 12 years, and we've yet to have any missed rent payments given COVID, given anything. So this is kind of a conservative approach to getting into DST.
Sometimes landlords will say that their financial goals with their properties is one thing, but their actions say another. And that's not a statement of judgment. It's an observation. When you've been involved in as many transactions as I have, I work with folks that own something as small as a duplex to the largest owner of multifamily properties here in the San Gabriel Valley is a client of mine, and I work with everybody in between. And there's really, if you boil it down, three segments of investors. And maybe one of them is sitting in your chair. The first segment of investors are those folks who they're still working or running a small business, like my wife and I. And maybe their properties supplement their income somewhat. But the real goal is that the income from their properties will replace them as a working individual somewhere down the road. Yet, for many of them, unfortunately, they buy a building, get too close to the tenants, paint the trim 3 and 4 times over. They wake up 20 years later sitting on the same building. A building that, in all honesty, was supposed to serve as a stepping stone, a springboard for bigger and better things. And for not having taken advantage of that time, now their cash flow and their overall wealth takes a hit. The second segment of investors are those who, as you sit here in this room today, your properties represent the vast majority of your retirement income. And from this segment, oftentimes I hear things like this. Well, Kris, now that they passed rent control, I have to be sure to raise my rents every year and to the maximum. They got caught flat-footed by rent control. And because now, unless a tenant moves out, and with vacancy control, that goes away, but for now, if a tenant moves out without that, their income many times is now not keeping pace with inflation. They're taking a hit directly to their pocketbooks, to that retirement income that is a direct correlation to their standard of living. And then the third segment of investors are those folks who are in their golden years. They've got the cash flow right where they want it. They're not looking at buying or selling anymore. And from them, I hear statements like this. Well, Kris, we like to take more vacations. We like to take extended trips. But we just don't do that as much as we'd like to because we'd hate to be away and then get a call from the tenants or there's an issue with one of the properties. In other words, the properties are dictating their standard of living. Well, let's go through some of this because there's a better way. There's definitely a better way. Achieve financial security. We've discussed how to increase cash flow, how to build wealth over time. Now, financial security. We know this, that markets change. There's ebbs and flows. Right now, we're in a downward trajectory when it comes to values. That's where we are in the cycle. So then, strategies must adjust. The strategies that I utilized for my portfolio, even 2 years ago, do not apply today, let alone 10 years ago. But we can adjust our strategy knowing that the fundamentals remain. Well, what are these fundamentals? Well, let's take a look at rental rates. Yes, they've pulled back here recently, but over time, we know that rental rates continue to go up. When we look at vacancy, especially here in Southern California, there simply is less units than there are people. And so vacancies over time continue to go down. Property values. We know that property values, again, here in Southern California, over time, they pull back here and there, but they continue to go up. But Kris, the Fed, they lowered the rate by 0.5%. This week, they promised they're going to continue to lower them. I hope so. But even if they do, as we mentioned earlier, it takes 1.5 years, 18 months to 24 months for the market to change direction. It's not a given that it's going to happen overnight. That would be great, but that's just not how things work. This chart, this is not my chart. This is from CoStar. They track all these things, and they've tracked the influence interest rates has on values for several decades, and that's what the reality is. So, 7 issues. It starts upstream with the economy. It's affected our rental rates. Interest rates are still having an effect. The politics and culture has brought about the tenant protections that we have today, increased tenant protections that we're going to see, and rent control has brought now the worst of what could be thought of, vacancy control. Growth says this: the only reason to own real estate is for cash flow, appreciation, and tax savings. Unless you like tenants, toilets, and trash. But I prefer cash flow, appreciation, tax savings. Well, as an investor, you and I have invested capital, time, And there's a certain level of risk, liability we're taking as a landlord. So for the same capital and time and risk that we already have invested in the market, why wouldn't we increase our cash flow, tax savings, and appreciation? And we'll discuss how to do that within the confines of the market today. And then the third and final pillar, prepare for tomorrow. That's for those folks who they're at a point where they're trying to decide, is it cash or properties that I give to my children? They would like to exit multifamily, but they don't know what to do with the capital gains tax burden. They're looking for a different way. They're looking for something that would replace the monthly cash flow. We're going to discuss that this afternoon. The financial legacy, maximization, growth, prepare for tomorrow. It's a very simple approach. And what you'll find is by approaching multifamily investment in this way, you inevitably check those three boxes. You will increase your cash flow, you will build wealth over time, you will land at a place of financial security.
Here to talk to you today about the changing laws in the landlord-tenant environment. As the last speaker said accurately, they're changing rapidly. And as part of this whole program Kris puts together, you should be considering the laws, where they're going, where they're at today. I do have some good news for a change. For the last, 4 or 5 years, all I bring you guys is bad news. The good news today, let me just see what that next slide is. There you go. Here's what we're going to talk about. The good news today is that this year was the best year we've had legislatively in about a decade. In other words, fewer anti-landlord laws got passed and put into place. We'll talk about some of those today. But that's the good news. Now, the rest of what I'm going to say is not as good news or not good news. When you're considering your investments, especially if your investments are here in Los Angeles County, I'm going to do a real quick poll. How many of you think you want to buy properties within the next 3 years, residential rental properties? Okay, about a third. Good for you guys. How many of you think you want to sell your properties within the next 3 years? Many of you guys. Okay. All right. Well, hopefully the whole point of what I'm going to show you today is to help you make that decision. So let's jump right into it. Expanding rent control versus just cause. If you're looking at your properties, any properties to buy or sell, one of the key factors is going to be whether it's under rent control or just cause. One of the biggest problems my clients are having right now is figuring out which ordinance applies to their property and then actually complying with it. The biggest challenge with these ordinances are the administrative challenges. And what I mean by that is, for example, some of these ordinances require you to register your property. Some of the ordinances require you have specific language in your notices. Some of them require you to have specific language in your leases. Some of them require to post the registration. Some of them require you to serve the registration. Some of them require you to post a notice of tenant's rights on the property. Some of them require you to put language in your notices that say that the tenant is entitled to a reasonable accommodation. Some of them, on top of all of this, some of them require that every time you serve a notice, you have to serve a notice of the tenant's rights under this just cause ordinance. And that wasn't even all of them. So you can see how that gets really problematic very quickly. And like I said, the trouble my clients are running into is that they don't understand the ordinances. So right off the bat, what I'm going to ask you guys to do is, one, figure out what ordinance covers your property. It's not, raise your hand if you have property in LA, not LA County, but city of LA. For you, it's a little bit more challenging. They have RSO, they allegedly have Tenant Protection Act, and then they have their own just cause ordinance that was enacted a couple years ago, Municipal Code 165. So you have to go through this whole analysis twice, a minimum, to figure out what is exactly applicable to your property. Here's the problem as far as evictions are concerned. Every single one of these ordinances say that unless you are in strict compliance, that it's an affirmative defense to the eviction. And so I have had clients recently lose their cases because they told us, oh yeah, we're in compliance, we've done everything we're supposed to, only to find out in the middle of the case that there was a hyper-technical administrative requirement that they didn't meet. And so that's the biggest challenge I see as far as right to counsel. On a bigger picture, let me explain to you why I want you guys to start digitizing your files. If you have to do an eviction, right now, the next slide is right to counsel. I'm gonna talk about this in a lot greater detail in a second. But if you have to do an eviction and the other side hits you with discovery, you only have 5 days to answer that discovery. And that creates a lot of problems and a lot of challenges for you. Most of the time, my clients can't get me the documents in time, which means I need to ask for a continuance and continue that trial. And so it's very problematic. So if you start digitizing all your files, for example, the certificate of occupancy determines, at least in part, what ordinance applies to your property. For example, the Tenant Protection Act. It says that the first question you're going to ask yourself is, what date was the certificate of occupancy issued? And if it's 15 years or more, which obviously is a rolling date, if it's 15 years or more, so far you're under the Tenant Protection Act. LA's is October 31st, 1978. But if you don't have those documents digitized, it makes me doing my job more challenging and slows your cases down. So we're starting to ask our clients, hey, look, start digitizing your files. Start understanding what these ordinances are. Read the ordinances. I know nobody wants to read the laws. I don't blame you. Here's the good news. This is all that passed this year that has a negative impact on you guys. Now, the first one is kind of a big deal, but if you've been watching any of my seminars over the last 10 years, you'll know that, 5 or 6 laws is nothing. It's not uncommon to have 20 laws pass in a year that are anti-landlord. So let's go through these real quick. AB 2347 increases the time tenants now have to respond to an eviction. It went from 5 days to 7 days. 5 days to 10 days. What that really means is now, if you hand a tenant a summons and complaint personally, they were supposed to have 5 days. Now they get 15 to 18 days because of the weekends. Depends on what day they get served. So that's obviously negative for you guys. Slows your cases down, allows them to stay in your unit rent-free a little bit longer. Kind of a pain in the rear for everybody. AB 2801, security deposit accounting changes. There's a lot to this, but all I'll tell you is now what this law says is you're going to have to, by law, take pictures at certain times. Starting January 1st, you have to take pictures before you make any repairs to the unit after the tenant moves out, and then you have to take pictures after you've repaired that condition. Starting next July, you are also legally bound to take pictures prior to the inception of the tenancy. Again, that's one, most landlords do that anyway, so that's not a huge deal. But now it's actually by law. So what they're trying to do is say, if you deduct the security deposit, you better have proof.
So this is the part where you get to participate. What I'm going to do is I'm going to take your questions. Hold any questions you have about evictions, because Mike Brennan, who was just up here scaring the living kapok out of all of us, is going to come back when we have the panel up here in just a few minutes. But for now, it's you. There's a microphone headed your way. If you put your hand up, this is going to be like popcorn. It starts very slowly. The first question will take a while. But by the time the panel walks up here, there'll be 15 questions that didn't get answered. And so this is your opportunity to ask anything you want.
Does it make sense to hold each investment property under a separate LLC? And if so,
Come back to you for the second piece of that question. So the idea with an LLC, a limited liability company, is it's like a watertight door on a ship. You know, in the ship, when you hit the Titanic hits the iceberg, and there's a watertight door that comes down in each compartment, and the people on the wrong side of the door drown, and the people on the right side of the door are saved. This is what happens. So in an LLC, a limited liability company, think of it as a forward-facing shield that everything inside the LLC is vulnerable to a lawsuit inside the LLC. But what it does is it protects everything else you own from it. So if you own an apartment building, whether it's 2 units or 200 units, and you have your property inside of that LLC and something goes wrong in there, you could lose that property, but you won't have personal liability on your own W-2 income, on your house, on your stocks, your bonds, any other apartments or investments you have. It protects it like a watertight door. So what you want to do is keep that inside, keep that property inside an LLC. If you put 2 in there, they're both on the water side, of the LLC. So you aren't protecting one from the other. They're both vulnerable to each other. So if a problem happens at property one and there's a judgment, property two is at risk. If you had them in separate LLCs, they're both protected. So why not have a separate LLC for everything? Because it costs money. It costs money to form the LLC, to maintain the LLC, to do all the things you have, separate checking accounts, separate checkbooks, separate bookkeeping, separate information returns. So that's the reason not to have more. The reason to have more is limitation of liability. So what I base it on is how much equity is in each property. Let's say you had $10,000 equity in one property and $100,000 in another. I'm not going to open a separate one for the $10,000. I'll probably put them together. But if I had two properties and they had $500,000 in this one and $800,000 equity in this one, probably want to protect them both. So it's a balance of cost versus risk, cost versus risk. Your second question.
Okay, thank you. So does it make more sense to open an LLC and file as a S corp, or just to open an S corp to begin with?
An S corp, meaning a chapter S, a subchapter S corporation, is something complete. It's a different entity. You don't need one. The ideal entity for owning income property is an LLC, a limited liability company. You don't need or want an S corp separately. So what should happen is property should be owned by your LLC, and your LLC should be owned by your trust, your estate plan, your trust, where when you die, the property goes where you say it goes. Again, property is owned by the LLC. The LLC is owned by a trust. It's that straightforward. I cannot tell you how many people we are discovering who don't have their LLCs up to date. They haven't done an updated estate plan in 2 years or 5 years or 15 years. They die and they have horrible tax consequences or bad control consequences or bad liability consequences because it wasn't done right. And it's pretty straightforward. There are two ways to do it, the right way and the wrong way. What we see is that the people who did it on the internet and who did it on the cheap and who did it without a state bar certified lawyer have trouble. The people who did it with a state bar certified estates and trusts attorney either did it right or they got a good claim for malpractice against that attorney. Either way, they're okay. So this is one where if you do it yourself and it turns out badly, you won't find out till you're dead, but your family will sure know.
Two questions. One, if you can talk about 1031 reverse 1031 exchange. And
Hold on, we'll come back to you for the second question. So a reverse exchange, a direct exchange, 1031 would be where you sell your property and then within 45 days you identify your upleg, could be a tick or a DST, and within 180 days of the close of the first escrow, you buy the second escrow, the upleg. A reverse exchange is the reverse. You buy the upleg because you have the money to do that. And then within those same time periods, you sell the downleg. That's what a reverse is. Second, blue microphone.
if you could just clarify the question the gentleman had about the discount, because I was thinking about raising the rent, but giving them a discount for taking over some of the work that I was doing at the house.
Yeah, I don't like discounts because they distort what your actual rent is. And you don't know how rent control ordinances, as they're passing, and they'll be passing, okay, over time. That's the trend in California. You don't know what they're going to be in the future or how they're going to say, gee, if you're giving a discount, then that's your floor rent, and that's what we'll base your future rent on. So I don't like discounts for that reason.
Does the landlord have the right to limit the number of people who can move into our unit by the size of the unit? Let's say, for example, we advertise a one bedroom, and then 4 people want to apply for that bedroom.
Where is Mike
He
Brennan?
limit-
Mike, are you in the room? Question was, can you limit the number of people who rent a unit? Fast answer.
You can limit it. Does it have any effect? Not really. For example, Pasadena's, their ordinance says that you can't necessarily terminate a tenancy for over occupancy, for unauthorized occupants. And I believe that that's where her property is located.
Yeah, the question is, if you are renting to someone and you're taking applications, can you say the only number of people you have in it is this number? You're saying, yes, you can limit it, but if they move in a bunch of people, can they throw them out?
That's correct. And to be more clear about my answer, the generally accepted rule is 2+1. You are allowed to limit occupancy. California is moving towards the building code rule now, which will be a lot more than 2+1. As we stand right now, general rule 2+1, you can limit it, yes.
Strategies if 33 does pass. Remember, 33 is the one that has vacancy control instead of vacancy decontrol. Right now you have decontrol, someone moves out, is thrown out, leaves voluntarily. Rent control says market value for the rent. That's what happens next.
So
Vacancy control says that doesn't happen. The ceiling is still on.
I might. Do you want me to use the handheld or? Lafayette walked away. Well, one, we should have stayed on top of our rental increases, right? But time's gone. If you, to Steve's comments, if you're not in it to win it, as they say, and you have 1 foot in and 1 foot out, you probably look at an alternative investment to sell and look at a DST or look at purchasing a triple net, doing something different. Because especially if your rents are well below market value, my guess would be for those properties that are well below market, similar how to I put those charts together with the interest rates and I showed you how much there was a change in value. I've worked the numbers on what I propose the cap rates will be. For those properties that have the lowest rents, I think you could see a change in value easily of 20%. Easily, overnight. And so you just have to ask yourself, if you already have 1 foot in and 1 foot out, is an alternative investment more up your alley? That would be my take.
Are there loans available today for substantial upgrade projects? Yeah, loans. Gail and Javier?
Yes, there's bridge products. So there's bridge products. We can do a cash out refi based on a market rent program or a bridge product, or even a construction project if you're looking to add ADUs or whatnot, whatever it may be, as far as an improvement, we could do a construction loan as well.
If there's a couple things you have to be concerned about with cash for keys. I do like them. Look to see if there's an anti-tenant harassment ordinance in place first that limits how you have to approach that. Second is look at the city, specifically their ordinance, to see if the tenant can be evicted for failing to vacate after they've signed that agreement. In LA, you cannot evict them. So you can't evict them just because they took your money and didn't move out like they said they would. But in other cities, you can.
I just want to add something. In City of LA, people are still signing cash for keys agreements, and what we do is when they sign in, we just give a small amount of money. And usually when someone signs is because they're gonna move out. Not all the cases, but I seen this in the past 5 years. At least 99% of the people, when they sign an agreement, is because they already made their mind and they will be moving out, hopefully.
Kris, you clearly have a pulse across multiple counties. What would you say that majority of your investors are doing right now?
So when you look at the buyer pool today, it used to be, if you would ask me, Kris, who's mainly buying multifamily properties 10 years ago, I would have said easily 70% of the investors that are purchasing are folks that already own multifamily property in a close geographic location to the property we were selling, existing investors. That's dramatically changed. If you look at, because my staff, we track this, today who's buying multifamily properties, it's 60% new money. 60% of folks who don't know what it was like prior to rent control. 60% of folks who don't remember the good days where eviction of court was fair in the sense of not free representation for the tenants on your dime and that sort of thing. They don't know any better, but they still have needs to shelter income. They don't like the stock market or what have you. But for those folks that remember the good old days, they're saying, yeah, if I am holding on, it's for tax purposes, but I'm surely not adding more, because why would I hit myself over the head with the issues that I already have? And for those that are doing a 1031 exchange, to Steve's points, it's because they have a good handle on things. They have good management practices, and they are looking to increase their income. They are looking to expand their portfolio. A lot of them from LA County are now exploring the Inland Empire, although they're maybe 5 years too late on some of the upswing we saw. Nonetheless, obviously there's still upside. And in San Bernardino County, for example, not one city in San Bernardino County has a local ordinance versus LA County, where several cities have their own rent control ordinance. So they're looking at other locations. But I would say multifamily people know multifamily, so they stay there. They don't sell and then go buy a warehouse or sell and buy a strip center, most. And those that are looking to do something completely than multifamily, something completely different, it's a DST.
Well, we've seen some lenders have a hurdle rate as far as qualifying the building, number one. So a higher interest rate just to qualify the building versus, the actual initial rate. We're also seeing, I've been seeing this in the last 6 months quite a bit, where they're looking at how seasoned our new tenants are, and they're looking at reserves, and more so than ever. And they're looking for, client history of management and net worth.
And Javier, obviously Chase Bank, especially being here local in the San Gabriel Valley, well known for the multifamily properties. But even there, it's not what it was doing a loan with Chase, say 5 years ago. So what, before someone calls your office, what should they anticipate is different today getting a loan with Chase versus, we'll call it the good old days?
I would say, the process is still the same. It's still minimal documentation. It's pretty straightforward. I can get you an answer relatively quickly. But in terms of the underwriting, kind of what we've been seeing, just the market changes. A lot has to do with inflation. A lot of it is driven by what the appraisal comes back with, right? A lot of the times we underwrite based on what the appraiser tells us they forecast market to be. And so that dictates a lot. And so what we've been seeing overall is that, even though you as an apartment owner may not have management, the appraiser is going to forecast a typical management fee. That's gone up a little bit over the years. Insurance cost obviously has gone up. So all of those things kind of get tricked, the increase in interest rate environment. So all of those things, when those variables get added on, you end up seeing a lower loan to value typically, than what you would expect. So those changes over the past couple years are driving kind of what we're seeing in the market in terms of loan to value and the ability to lend, on the upper end or a little bit, under of what expectations would typically be, let's say 5 years ago.
What are the average returns that we're seeing on DST investments? I know more and more landlords are moving in that direction. Is that a good move?
So the average returns that you're seeing from a cash flow standpoint is they're usually coming in still in the mid 4s to mid 5% on your equity. So we're not really into, if you go back to 2005, 2008, you were seeing these types of investments yielding 7 or 8% cash flows. We're not there. And a big factor there has been where the cap rates have gone. As cap rates gone down, means property is more expensive. And then if it's a levered DST, then the interest rates are still now up in the 6s on the leverage. And that actually is detrimental to the cash flow. But you should be able to find DSTs easily in the 4.5% to 5.5% range on your equity.
But if someone has depreciated out their property and you own a apartment building and then you exchange into a DST, does that depreciation start all over?
The depreciation, I mentioned this when I was up here earlier. If you do not take on new debt when you do a 1031 exchange, then your old tax basis, your old depreciation just flows forward into the new DST. But if you buy a DST, let's just say that you sell your property for $1 million and you decide to go into a DST that has 50% leverage, then you're really buying $2 million with your $1 million. And so you're picking up new tax basis of $1 million. and that $1 million can be depreciated all over again, even though the DST is paying the debt, and even though you personally are not liable and recourse on that debt, you still get credit for it. So that's a nice feature that you could do. If you do a DST, you can actually pick up tax breaks.
We are Edgar and Monica Tajoro. We own in Pomona.
So me, it was everything.
Yeah, it was,
Yeah,
it
I
was
was
full,
soaking everything up.
full of information, and I was
Yeah.
just gonna say that I was at the last event. I was gonna say, oh, it's just gonna be the same thing, but it's not.
But it's not.
It's
my
not.
first
There's
time.
a lot of new information. There you go. Multifamily is very diverse, very complicated. Kind of like what Kris was saying. You gotta have a plan.
Yeah, my favorite part was the Q&A section. The Q&A part. That was very helpful too. Yeah.
We'll do it again, man. We'll do it again. Like we're saying, like what they were saying today, the days of, buying and things just working out for you are probably over. You got to educate yourself. You got to have a plan, and you have a room full of experts. This is a great event. Very nice of you guys to put this together.
My name is Michelle. I own an apartment building in La Puente. This is my first time attending this seminar. It's actually very, very informative from everything I was looking for an answer. I do have my own management company to manage it, but I thought it's very helpful to have me as the landlord to have the first-hand information from all different area of expert, from legal, from financing, and the exit strategy. Yes, I actually do personally know a lot of landlord as my friends. So I was very surprised about today's event, and I would absolutely recommend and actually drag them to here next year. Thank you very much.
Shiva Bhaskar with LME Investments. We own in LA County, primarily South LA and the surrounding areas. It was a great experience, learned a lot, got to hear some great perspectives, very educational. No sales pitch, which was great. I thought hearing the actual strategies used by other owners like Kris and other people he discussed. It's one thing to hear it, it's one thing to see what other people like us are doing, so that was great. I would encourage them to attend. That was very helpful.
My name is Jaime Bejarano. I own in City of Los Angeles, City of Cudahy, City of Ontario, Pomona, and Montclair. Very informative, educational, and crucial because of some of the laws that we're unaware of. Some of the mistakes that we make as landlords, thinking that we know all the answers and, but not up with all the changes that exist today. But some of the speakers that we have really gave me a lot of insight, and more importantly, to go and seek their knowledge and expertise going forward. Just the overall strategy to rethink my strategy going forward, as opposed to being thinking, I guess, in a tunnel vision, but open horizons and seeing it from their perspective and their experience. I would encourage anyone to come to this seminar as often as it could or whenever the opportunity comes, because it is something that will help them immensely, because we are not all experts in every facet of owning real estate on our own.
My name is Sherry Babb. I own almost Cypress, Fontana, and El Monte, La Puente. I have quite a few. Lots of information. I can not say how many times I attended these seminars, but I can say this seminar, every time I attend, save me thousands. I learn any idea I catch up, I can go back, talk to my management company, say, hey, try this, and it works so good. Very, very lots of information. If you get a chance to know this seminar, you should go. I will pay $1,000 a time to come here. And the information is so much. Lots of information and so useful, and they update. Every time I come, they have different, most updated information.
My name is Jim Ranella, and we own we have a few duplexes and a 6-unit. Oh, it was very informative. Basically, my wife is the one that runs the real estate part of our business, and she dragged me here. I'm glad I came, because I believe the experts that were up on stage, that type of information you can't call anybody and get that type of group assembled and have your questions answered. The legal aspects of where the real estate market is going to, some of the things that we should be aware of what's being done. The exchange, what can be done with an exchange, or even the tenant eviction policies, what's available to us. I think that he'll become very knowledgeable, much more knowledgeable on what he's doing to feel comfortable and to grow with his investments.